Schiavo. And Bruce, thank you very much. I am an alumnus of the Lumen School of Business, and it's just great to be back at the university. Although I've been here many times in various capacities, as Bruce stated, and it's great to basically help out with Bruce. And the students here are lucky that they have, very fortunate that they have Bruce Beckenheimer. Today is the basic financial statements, and next week is the financial statement analysis. Just one note that any accounting or tax comments that or tax items that are discussed here are just for illustrative purposes only. I mean, in your own businesses, you may have an accounting issue, you may have a tax issue, and you really need to drill down to the set of the details, the facts, the contracts, agreements, the tax rulings, etc., the parties involved, etc. So just keep that in mind. There is literature, accounting literature, the tax code, but you need to take all these items into account. Today's purpose is, as Bruce stated, very, very high level. Very high level to be conversational, say, with an investor, a banker, a vendor, etc., other stakeholders in your business, whether they may be an investor or they may be a vendor. A vendor is a stakeholder because you're selling to them, and in turn they're providing cash flow to you. Okay, so we're going to, I know Bruce asked me to talk about the basic financial statements, but I will get into the books and records. We will then get into the heart of today's session, which are the three basic financial statements, accounting software, and you will see in the year 2012 why that is so important. And I'm sure you obviously you utilize that already. I was on the PACE Entrepreneurship website, and I know there's comments about QuickBooks, Xero.com. Exactly, those are you're in the right, you're headed in the right direction, and we'll touch upon that. Why that is important. Why that is important. And then we'll get into questions and answers. Okay, so books and records. Very important so let's say you have a business, right? Okay, create a balance sheet, but wait a minute, you gotta take a step back, and you have to look at this to say, what is your, quote, operational infrastructure? Not in manufacturing, say I don't know, let's say if you're manufacturing a bottle, but the accounting operations themselves. And why is that important? Okay, so today is day one of your business, but 6 months, a year from now, you will have cash flow, and you want to analyze the business. But if you don't have proper accounting records, how could you prepare proper financial statements? Okay, so therefore, what you're analyzing, as they say, garbage in is garbage out. Think down the road, if you were to bring in a partner, they're going to do due diligence. I worked for consulting firms where we've been hired by the bankers, etc., to go into a company where they either want to make an investment or provide lending, and I've been asked to provide due diligence on the financial statements. Okay, or say you were going public and you have the auditors. How can they audit an environment where there's no controls in place? And then as you go public, there's items like Sarbanes-Oxley, etc. So you need to think on day one the future of your business. Obviously in the E-Lab, there's many aspects. One is the accounting infrastructure. And this is very high level. So we'll go through just a typical transaction. And you sell, okay, let's say you're in the business of, selling bottled water. You sell it, you provide an invoice, right? And that's your source document. Okay, you have create accounts receivable in your accounting records, And then from there you could have a, various journals, accounts receivable, because, so you want to do an aging of, you have many sales, and then you just create a journal of accounts receivable. You have all of your accounts receivable, and then you could age them. Or say you're paying, that you have to pay a vendor in order terms for the label. Okay, that's accounts payable. You want to know that. I mean, that's how you manage your business. In other words, you could say I've got great sales, but how old are they? Are they 30, 60, 90 days past due? Well, that's what the accounting records provide us with, that source data. And that's how you can manage. So if you know your terms are net 30, and then after 45, 60 days, you're going into your accounting records and you see something past due, you can follow up with that counterparty and ascertain and inform them that your invoice is past due. Again, if you did not have the proper accounting records, it would be hard to do. You created a sale, but you have not received the cash because you were unable to follow up because you had improper accounting records. So on this slide is then we take all this detail and then we sum it into a trial balance. You prepare your financial statements, and then ultimately you issue these financial statements, whether it's if you're public, to your investors, if you have a partner, or the bankers, etc. But the walk-away point with books and records, think of a sale, think of the documents that are required, and then all the documentation, the debit account, receivable, credit sale, etc., which helps you produce timely and accurate financial statements. Okay? What I'm going to do next is go into the financial statements, and then I'm going to sum it up where you'll see how the books and records and the financial statements, they're generated way of this accounting software that is out there. And putting the books and records together, putting your financial statements and having it on accounting software will help you manage your business help you manage your business properly in terms of the financial information. Okay, so the basic financial statements: a balance sheet, an income statement, and a statement of cash flows. And those are my three basic financial statements. Let's walk through the balance sheet. Okay. So the balance sheet, and as everybody knows from their accounting class, it's just a point in time. Usually they're issued, produced. I know there's a monthly close, but in terms of preparing a full set of financials, either quarterly, or obviously as you see with the held companies, they provide audited financial statements at year-end. And there's three aspects: the assets, the liabilities, and the equity. So consider your business. What would be an asset? It's what the company owns. It's cash. It's an account receivable. Or it could be if you have a patent. Those are items that the company owns. And at the end of the day, at some point in time, the objective is to convert it into cash. Liabilities is the other. Let's say it's the other side of the balance sheet, and in that aspect, it's what you owe. For an example, in order to sell this bottle of water, you obviously had to purchase the label from a manufacturer, and you owe that. So really, a liability is it's legally binding, and you owe that. You owe that that obligation, and that's usually a cash outlay. Equity, partnership, equity if it's a corporation, it's a partnership capital, etc. It's the actual interest in the in the corporation, in the partnership. So really, it's the assets, which is really what you owe. Could be assets equals liabilities plus the equity. Let's look at the balance sheet, and in terms of more of the form that it takes, and the form that it takes. And as I mentioned, assets on you have your assets, then you have your liabilities, and then obviously the remainder is owner's equity. Okay, so if you have an item cash and you have a liability, if your cash is 100 and your liability is 80, obviously your equity, the ownership stake is going to be 20. And obviously, because you have the $100 cash, let's assume then you make the payment to the vendor for 80, and you're left with 20. And the way the balance sheet is I'll say formatted, okay, where the items that are most likely, the items that be converted to cash is from liquid to, say, illiquid. For an example, it starts off with current assets, which could be cash, accounts receivable. Because obviously cash is liquid, you have a bank account, accounts receivable, assuming 30, 60 days. And then if you have fixed assets, if you were to, say purchase a laptop, right, that's, little illiquid. Obviously you can't, obviously I can sell it to you today, but let's assume it takes time. And then a patent is, an intangible, and you obviously could, sell that, but it's more, in terms of converting to cash, it's not, okay, I have a bank account, I'll make a payment, etc. I mean, you have an actual asset, and you would actually own it and sell it. Liabilities, similar in terms of the obligation more from liquid, in terms of the accounts payable, all the way to a long-term liability. For an example, let's say you took out a 5-year loan, okay, or your company issued floated bonds, okay, to generate for cash, okay. That's the long-term. That's long-term. In other words, it goes out more than, say, it's more than a year. And that's the general, and that's basically how people read. That's how people read the financial statements. And then owner's equity is, it's your ownership interest, which is the, could be stock, and then the remaining part is retained earnings. I'll drill down now more into specifically so you saw the form. Now here's a drill down on the specific types of accounts. Again, it's, what can be converted into cash. Examples are cash, accounts receivable, short-term investments. Then we move further down into, we go from liquid to illiquid. Again, fixed assets, building, land, other assets. Again, as you can see, where you go from cash down to items that are less liquid or illiquid. Liabilities, the same thing, where you're going from, okay, accounts payable. What is it? Credit extended to buy supplies to a firm when it purchases inventories. Again, you sell bottled water, but you need to buy this label. Okay, you owe the vendor for that. Then you have long-term debt. Again, then you have debt, and again, that's it can be classified as current or long-term. Okay. For example, if you were had a 5-year loan, and you'll see next week when we go into the ratios that it's broken up into current versus long-term. Because obviously, let's say you have a 5-year loan, and maybe payments are made monthly, or bonds where you're going to make semi-annual payments. Okay, they want to see what's due. Financial statements are written where what is due short-term within 1 year, and then long-term greater than the 1 year period. Again, then you have stockholders equity. So before I go on to the income statement, a recap of the balance sheet. It's assets equals liabilities plus stockholders equity plus capital. Okay. Now every business can, in terms of the details, it's obviously based upon the type of business. Okay. If you were to look at Microsoft's balance sheet, obviously it would be different versus a Ford Motor Company. Okay, so different industries. But at the end of the day, it's what's their cash. Everyone has cash. Everyone has short-term investments. Everyone has fixed assets. So it's in that formality. The next financial statement is the income statement. Where the balance sheet is at a point in time, in other words, what is my cash, what is my liabilities, the income statement, it's over a period of time. Okay, so you could have what happened for the month, on November 30, on November 30th, you could have a monthly income statement. It says, okay, what were my results for the month? You could have a quarterly, March 31st, June 30th. You could have a semi-annual. You could have an annual. And you'll see next week. But why do we have this over a period of time? Some companies are seasonal. Okay, and you want to see the activity over a period of time. And the income statement, we're going to go into specific details, but basically it's sales minus expenses, revenue minus expenses equals profit or loss or net income. I mean, that's the general, that's quite the very quick explanation of a income statement, okay? However, and I think Bruce mentioned this in the introduction, is that you need to break it down. Similar to where you have the balance sheet, and you have it from liquid to illiquid. In an income statement, you need to break down, you have sales less cost of goods sold equals your gross profit. And as was mentioned, I have these goods, right? But what is the cost? What is the cost to manufacture this? Okay, and that's where it's in the cost of goods. Then equals my gross profit from the product. We're going to get into the operating expenses, but that's, for example, payroll, lights for the manufacturing plant, etc. And that brings me down to operating income, and then you reduce your interest expense and your income taxes, which brings me down to net income. Now, we go through these details and say, well, Nick, you said the income statement is sales minus expenses equals profit or loss. Absolutely, okay, but that's basic accounting definition. As you become as you're a business owner, financial manager, investor, etc., these details, really focus on the business operations. and you'll see later, and you'll see next week how you break these items down into these details. It will help you financially manage your business. It tells a story. It tells a story where to your lenders, your investors. It tells a story to yourself as a business owner and one who should be a manager of your finances. It helps you in that aspect. Okay. Again, I'm going to then break this down, further. As you can see, I'm starting very high level, and we're drilling down. And that's really, with your financial statements, and that's the key. The key is to think big picture, what is my business, and then start drilling down. Because the numbers are good, but unless you really drill down and understand it, what am I analyzing? What are the numbers telling me about my business? Well, revenue is the very simple, selling the company's product. Cost of goods sold, again, it's the cost of, if I'm in the business of producing this water bottle, okay, I have a manufacturing plant, and there's a cost for this bottle, there's a cost for this. This tells me specifically about my product, okay? Then you have operating expenses, okay, which, for the firm as a whole. So now you're out there then marketing because you need to generate sales, okay? So you're out marketing, okay? You're out payroll. You payroll. This is the operations of the business itself. I'll get further into that, but okay, so then again you have your financing cost, which is okay. Say I wanted to build a manufacturing plant. Okay, I may obtain financing. And readers of financial statements want to see that separate, and you place that as a separate line item. And then obviously there's taxes. So we're going to drill down into these items further detail, but again, we start very high level. Sales minus expenses equals net income, and then we start drilling down into the actual product itself, and then we drill down separately into the business itself with your, in terms of your operating expenses, and then we focus on, okay, did I obtain financing? Well, I want to know that amount separately because I utilize that in order to grow my business. Then obviously there's a tax aspect too. Okay. So you can see how we're drilling down. And next week, as we analyze, there's a reason we'll see what is our financing, and sometimes treasurers use this to say, okay, is there a cheaper form of financing, etc. That's why you segregate these items. Okay. As you can see, it's just like I said, expenses are grouped by function. Okay. Manufacturing, cost of goods sold, okay, general and admin, payroll for that office clerk, payroll for the floor manager, sales and marketing. You have to market the product. You have to product development. Okay, the next and the last item, and perhaps the most important, is a statement of cash flows. Cash is king. I think you've heard that in all your classes, right? Yes. And this is, let me just, okay. Cash is king. And if you don't have cash, if you're not generating cash, look, I'll use the account receivable as a great example, okay? this goes back to my comment about, okay, on my balance sheet, I have assets, and I have accounts receivable. So, right, I sell this, right, and I have accounts receivable. Okay, I sell it, terms net 30 days. Well, that's good, and I will, debit accounts receivable on my, on my balance sheet, and credit, sales. But okay, you need to, collect, so you can then, net 30 days, and bring the cash in. So you can then take that cash and then hopefully reinvest it, pay out a dividend to the investors, etc. Okay, so that's cash is king. Now, similar to the balance sheet and the income statement, where we segregate items for for the owner, for the investors, the bankers, etc., to analyze, to manage the business. The same thing with the cash flows. You segregate it into 3 components: operating, investing, and financing. Now, one could also argue that there is, I will state that there is, forms of cash flows like direct and indirect, but we'll leave that for your accounting class. This is more just in general, just a general discussion of cash flows. So on your operating, let's take component 1, operating, and that's cash generated from, let's say, changes in working capital. Okay, so if you have a change in account receivable from one year to the next, you're going to generate, that's cash. Cash has been generated. Because remember, in year 1, you had a sale of of 10, and that was on the balance sheet. And then in year 2, you had sales, and your accounts receivable is 9. So you really had a change in cash, right, of $1. Okay, and it's important to know. And the same thing on the liabilities side also. Investing, that includes purchases that were made, and then finances could be when you say issue. Let's say when you issue bonds. Again, it's just the financing, and why we issue bonds, perhaps to generate cash to build that plant, or to make that so the form, and again, it's just, this is more of a drill down as to what I was saying previously. So you start with your net income, okay, from your income statement. And net income, again, is that's just the sales less the expenses. And then obviously from there you have your sources and your uses of cash. Your change in accounts payable and receivable, changes in increase or decrease in inventory. If you think about it, that's really operating. That's just the operations of the business. What is my just operating this company? What is the type of cash that is being generated from that? Is it positive? Is it negative? And we'll see next week. But that's why we're segregating the components of cash for that reason. And if we have a trend of cash that is, we can have great sales, but if the cash from the operations is decreasing year over year, well, maybe we're not collecting. Okay, it goes back to that collection, or maybe. Then the next item is investing, and this is really more one of the strategic investments versus cash used to acquire fixed assets. In other words, if you're going to purchase property, plant, or equipment. And the last item is the financing activities. Okay, again, you're segregating it. If I'm going to issue notes payable, bonds, or just raising equity. So those are the three components. And then you have your cash at the beginning of the year. So it's really 1, 2, and 3 to net, plus the cash at the beginning of the year gets me to my cash at the end of the year. You know, and then that's math, but I think the walk-away point is to understand that there's three components: the operations, the long-term investing, and then the financing. And I'm going to drill down next week into these components. And but that's really, you know, in terms of analyzing these financial statements. But again, before I get into accounting software, as you can see, you know, for the past half hour, I was trying to build a case. I was trying to build a case of that. Okay, I have a business, right? I have a business, and I'm creating sales, and then those sales are going to, you know, convert into. I'm creating sales. I have payables. I'm investing in I may buy a patent from someone to help in my business, and those convert into financial activity, which appear on the financial statements. And based upon the type of activity, you know, we classify them accordingly. Again, if we purchase a patent, create a patent, obviously it has a certain component on the balance sheet. If we have, if we invest in if we pay a salesman on my income statement, it's going to have a certain classification. And again, if I'm going to issue notes payable, I want to see how that cash or bonds are redeemed. I actually want to see that component illustrated on my financial statement. So those are the walk-away points in terms of saying, okay, I have a business. Whether I'm preparing the financial model for my business plan, or I actually have cash flow from sales, you need to segregate all of these components. So you say, Nick, well, that's great, and that's, you know, I'm an owner, I'm running a business, I'm managing a business, I'm going from one meeting to another. I'm either working with the plant manager, I'm either trying to close a sale, I'm trying to hire, etc. You know, that's really sexy and that's really great stuff. But, you know, I have to take care of this accounting. You're telling me I have to take care of this accounting, and you're telling me I have to break down my financial statements, etc. That's correct. You have to do that. It's important because in terms of financially managing your business. It's great that you're having sales, and we will see next week where we get into account receivable turnover that you want to manage that ratio. But the way you manage it is that your infrastructure in terms of, you know, the documentation, the books and records, the financial statement classification is proper. You know, if my cash flow from operating activities, or just in operating the business, is decreased over the past three years, why? Well, that's why we segregate the cash flow. Okay, or if a banker wants to see in terms of my financing activities. Okay, so you're lucky. It's the year 2012, and to be a business owner and to manage your accounting, your finances, it's becoming a lot easier today than it was probably 5 years ago, probably 10 years ago, and obviously a lot easier when I took Accounting 101, here many years ago. Okay, there's accounting software out there like QuickBooks. I'm sure everyone has used QuickBooks, Xero.com, and that's important. It's important because it basically could create your accounts payable journal, your accounts receivable journal. It could produce invoicing. It's integrated. In other words, I input sales, I input a customer, I can create an invoice. From there, I can produce an accounts receivable journal and analyze aging. I can create financial statements for myself. I can create financial statement ratios, which we'll see next week. If I want to bring on a partner, I can easily produce a set of financial statements from there in a timely and in an accurate manner. If you had, say, a VC firm, you'd have to produce, they would want metrics. They want metrics monthly, quarterly, etc. And investors today are looking for transparency. Transparency is very important, especially as you see a lot of the enterprise risk items that you see in the Wall Street Journal today about various companies. And that's why I go back and I started the session with books and records, okay, and with financial statements. And yes, I know we've had spreadsheets, and those are good. I know people use them for projections, and that's fine, and that's great. And I love the pivot tables, and I love the the NPV functions. Those are terrific. But there's some risk in doing that in terms of a general ledger, using it as a general ledger. And that's why today you're lucky where you have QuickBooks or you have Xero, items like Xero.com and others that utilize that. And I strongly recommend you could, it's even on the cloud now. I'm the treasurer of a nonprofit association, and I've implemented QuickBooks, and it's terrific. It's just like I can do a monthly close. I can download it from our online banking statement, and from there, I provide monthly analysis to the board members. I could actually download information quickly, and it helps me be more of a financial partner to the board. And if, as a business owner, you would want that to just basically be, you want to be a financial partner to your investors. Okay. In terms of the software, this is just a very high level. For a firm that was recently at, we had looked at, we purchased a fund accounting software, and I did due diligence. And some of the items is, your level of support, the quality of the documentation, the functionality, your existing hardware. I know with QuickBooks it's off the shelf, but as you grow your business, you may want to expand that software package. You may have a specific type of business which requires specific types of software, and these are the items that you would look at. Okay, but the price point is low. The output in terms of a control environment, which is important. The output of producing specific, even in QuickBooks, they give you the option, as you know, in terms of producing various industry type of financial statements. Okay, I work for a fund administrator, and we actually, there's vendors out there that specifically have specific types of investment accounting software. So it's out there. The price point is low, the output is terrific, and in today's environment where investors bankers, etc., are looking for transparency, where you would want to have data quickly at your fingertips. It's software does that. Software does that today. Okay, well that wraps up the basic financial statements. And next week we're going to do an analysis of the financial statements.